Hey everybody, Boris Schlossberg, BK Forex. Welcome to our Forex Weekly Technicals for 0690614 of 2014. Where are the trades? Well, I think the primary takeaway, of course, this week was the ECB rate decision and the flip of the market against the target of the ECB. Basically, ECB cutting rates to negative, but the market rejecting the idea that this is negative euros. There's a couple reasons fundamentally where I think this is true. My friend Ashraf Laidi, I think, pointed out to the best possible idea. Even though rates are negative in Europe, the actual real yield of interest, that is the yield on the German bonds versus the deflation that is existent in the region, is still bigger than the yield on the US Treasuries against the inflation here. So the real interest rate, in fact, is still positive, which is in some ways does support the euro for the short term being. Also, the other, I think, interesting fundamental explanation for this was that the Chinese are just basically harvesting European sovereign bonds the way they used to do with U.S. Sovereign bonds in order to recirculate their currency reserves, and that could be another very big buy. There's clearly buyers here, especially at the 3,500. We talked about the idea that 35 was definitely a big support level, and you can see this on a technical basis. You see how we just tickled it yesterday and supported it. To me, the single biggest takeaway from the whole ECB press conference this week was the fact that Draghi basically said, "Hey, we're done. We're done. We're not going to cut rates anymore." And that was the single biggest signal for the market to basically reject his policy. Now, long term, it could still be a situation where the euro goes down. And in fact, so we're at a very interesting critical juncture here. If you can take a massive punt here positionally and say this is it, is a double bottom. Euro goes nowhere but up, back up to 39, 30, 40, 100 as we've hit the bottom of the range. Or you could say, okay, this is the first probe of the bottom. And I really think this is true. I think that to be fully convinced that the euro negative story is essentially done, you really need to have it retake and hold on a closing basis somewhere around 37.50, 30, somewhere around the neckline here that it broke at the beginning of May after the ECB press conference. Now, if that happens, by the way, this will be one of the most annoying, treacherous markets you can imagine. Look at this. We basically will have done nothing but ranged for the whole year in a whopping 450-point range. I have a massive toothache as I'm doing this, and I think that is more preferable than the kind of trading environment that this would bring up. But be that as it may, that's really what the charts are telling us. So the very, very minimum, I think the point is the fact that we bounced off this 35. 35 clearly is the strong support. We'll have to see how the trade comes out next week. The big thing here is we've probed this 36.70 upside, have not been able to take it out. And I think what's interesting here is just as 35 saw an inordinate amount of buyers and brought us back up, there is clearly sellers at 37. And I think there are probably what I would call value proposition sellers at 37, 37.50, all lined up, just basically waiting for the euro to do another short squeeze rally to get themselves at better prices. Because I think ultimately the market still thinks this is more of a sell than a buy. But for now, this has been a positive bounce off, and there should be at least a little bit of continuation of momentum to the upside. At very minimum, we have this potential continuation towards 37, 37.50 on a technical basis in the euro, and we'll have to see how it plays out as next week comes up. Dollar yen is just treading water, very similar to U.S. yields. I mean, it's interesting. U.S. yields went down to 240, so we dipped over here, came back up about 250, close to 260. We dipped back up, and that's really the story. So if you want to talk about mind-numbingly boring ranges, here's the 101, 103 range. That's basically the story in dollar yen. And I think going forward, you'd have to be way out of consensus bull to believe that U.S. yields can kind of race up unimpeded. Bottom line is, if you think that there's very little possibility U.S. yields going to go 275 or higher in the next month and a half, then we're clearly coming up to more of a topping formation here at the 103. The 103 is a sell. I think at very minimum probably going to need another NFP to kind of bring the yields over the hump of this number, unless U.S. data just starts to print tremendously strong, and I don't think it is. I actually think that we're steady as she goes with a modest downward cast in the economy, which is what the yields are kind of telegraphing, and the prices are signaling that every rally in dollar yen is kind of very minuscule. Having said this, though, it's not exactly a screaming short as well. So you have this kind of a range bound trade, and coming up into the higher end of the ranges, it may make sense a little bit here to kind of scale. Basically, it's a scale up trade starting here through 103s with 103.50 stop outs. So if you sort of believe that this is the upper end of the range, we're not going to make it, and we're going to curl back down, you may be able to attempt to trade this. But it's just a very, very slow moving trade. Cable trading a little bit better. What's interesting about cable is next week we do have a couple more data points, and especially the UK labor data. If that prints hot, and there's some potential that it will because the PMI data has certainly been good. Again, the market, I think, is going to put more pressure on the BOE to begin inching towards a rate hiking regime. Remember, it's in a land of the blind, one-eyed man is king, and with no yield anywhere, even if somebody gives you 25 basis points, it's going to attract some specs. So cable still looks relatively good. What's interesting about cable, just on a technical basis, is just how well it's respecting its trend line here. Still looks to be relatively bullish all the way here, and if you can trace them all the way out here. And I think, if nothing else, as long as we sort of stay effectively, really, let me just take this off. Effectively, if we stay above, or if the support, we talked about the idea of 6650 as being supported, and support actually came in at around 6,700. But this whole 67, 6650 is the rock bottom support here in the cable formation. And so it looks to be relatively steady, and as long as we can maintain that support, it still has a small upward bias. But it does have to fight the run here at 69 and the run here at 69.50. It still points its way ultimately towards the 70.50 target on a long-term basis technically, but we have to see how it trades out. I think it's going to be very slow going for the time being. So what is surprising here is the bust out in Aussie through the 92-93 range, and that's again just a beneficiary of low European rates. That's really nothing to do with anything Australia does. It's again hunt for yield. It's the flow out of euro into the Aussie as everybody's looking for yield. I actually talked a little bit about this when I did CNBC this afternoon, yesterday, and it seems to be coming to fruition. Bottom line is, unless we get just monstrously bad numbers out of Australia employment this week, it's hard to fathom that Aussie drops all the way below 92. So it seems like every dip here, basically Aussie is kind of a buy the dip mentality in a very, very small upward range. It is capped at 94 and 94.50. That is a much more significant level. And I do think that I think if Aussie starts to trade up to 95 on kind of yield hunting, yield chasing flows, you're going to get a lot more hand-wringing rhetoric out of RBA. You're going to get a lot more RBA basically yelling at the megaphone that the currency is too high and threatening to lower rates just to push itself down. But in the meantime, if the macro supports, you definitely have a relatively decent upward bias. And even if macro sort of is weak but not horrendously weak, let's say the employment is just tepid and you have a little bit of a correction, I think every correction here is a buy until 92, which is kind of an interesting trade here, as Aussie definitely changed its posture just a bit. Kiwi has the rate coming up. Kiwi definitely sold off on quite a lot of assumptions. Lower milk prices, lower growth expectations, perhaps fears that the RBNC is not going to be as hawkish as they are. So now I think Kiwi may be finally starting to show a little bit of anticipation towards an RBNZ rate hike, and more importantly, trying to price in perhaps the fact that RBNZ is going to stay on track. The big story with Kiwi here, when you need to watch fundamentally and technically, is I think they have about 75 basis points priced into the curve. And if RBNZ in any way, shape, or form suggests that, hey, maybe we're not going to go to full 75 basis points, then you will have a massive disappointment. This 84 was a big level. We traded the 85 break and made it almost all the way out to 84. If we revisit this and crash through this barrier here, the next level is 82.50. That'll be the market disappointment on RBNZ really changing the perception of just how much yield they're going to give to the Kiwi. But if they stay stationary, we could have a trade right back up towards the 86.50, 87 highs. Still, long-term distributive, but there may be a potential here for a couple hundred points to the upside if the RBNZ sticks to its rate posture. And then last, dollar CAD. Last and least, because it's really nothing going on over here. Dollar CAD is kind of just right back into a very, very tight range. The data out of Canada is as tepid as the personality of the BOC president, and we're not doing much. There's little here to see, and I think the CAD trade at this point certainly is a very clear 108.50 support, and probably a pretty decent clear 110 resistance. And there's probably a lot of corporate core and everybody else trying to sell ahead of the 110. Not much on the plate this week, and probably not much interest in the CAD. CAD is really going to be a trade through the crosses, just basically an expression of other currency strengths or weaknesses. So looking at the crosses, let's just take a look at the Euro complex for just a second. I just want to see one interesting thing I think that's popping up on the radar is this whole short covering trade in the euro is bringing us back to the 140 range, which is 140 is a pretty decent level here. That was a big support level, which now of course becomes resistance, but a break above here really could take us towards a 41, 42. This basically assumes that U.S. rates are not going to dip again, so the yen component of this is relatively protected, and you have maybe another 100, 150 point short covering rally in the euro. It's really going to be a euro trade through the euro yen cross that could help move us forward. Then the other story I think that's going to be interesting here is how the euro trades against the Aussie, given the Australian. Here we are. Given the Australian data, and if Australian data comes in bullish, I think the Euro Aussie cross. One of the interesting things here is that the Aussie has expressed pretty serious strength against the euro, and even despite the fact that the euro did a lot of short covering. So if we get a powerful move on the employment front, that is, Australia looks relatively good, we have a chance here to break the 45s, and a break of 45s I think really opens up a run all the way possibly to 43s. So I'd be watching that level very carefully to the downside. The upside is not as interesting, but a downside here, a break of 145, seminal level here could be another interesting trade as the week shapes up. Next week, guys, I am off. I will not be around. There will not be weekly technicals. I'll be in Madrid. Those of you who are going to be at the Madrid Forex for a Living conference, I'd love to see you. Otherwise, I'll see you guys in 2 weeks. I wish you all the best of luck and the best of trading. Boris Schlossberg for BK Forex, over and out.